interestingly enough, my peers were like, okay, this is interesting, because macro people are curious by nature. They want to know what this is this an opportunity for me? And I explained to people, listen, I said, I've done the maths here badly, because I'm not a statistician. In fact, I failed all my stats classes. But if I look at the gold above ground supply and the known reserves and apply that to Bitcoin, so it's called a stock to flow, I said, I think Bitcoin's worth $1 million with gold at 1,300 at the time. I then also said, oh, and I'm also an idiot, so I'll discount myself by 90%. So let's assume 100 grand is fair value. And it was $200. So I'm like, this is the best reward any of us are ever going to see in our entire careers. And everyone got it.
Raoul Pal, ever since he first stumbled across Bitcoin way back in 2012, believes that Bitcoin should be worth $1 million per coin and that it is the single best risk to reward investment opportunity we will ever see in our lifetime. Funnily enough, after her own firm's analysis and breakdown, Raoul's prediction echoes a prediction from Cathie Wood and her firm ARK Invest, which are calling for a $1 million Bitcoin price by 2030. Since 2012, Raoul has now come around and believes Ethereum is an even higher risk to reward play. However, he is still incredibly bullish on Bitcoin too and the entire crypto asset space. In this interview, he breaks down why he's bullish heading into 2023 and why that with the rate of change of interest rates looking to go to zero in the next few months, crypto will have its biggest headwind removed and will be poised for explosive growth due to its exponential adoption. Also, only a small percentage of my viewers are actually subscribed. If you enjoy finance content, consider subscribing or liking the video. It's free and you can always change your mind.
Cut to the first video on Real Vision where we mentioned Bitcoin, and it's like, it's a scam, it's ridiculous, you need to own gold. Remember, gold was at $1,300 back in 2012. And where is gold today? Just double checking. Gold today is $1,600. Bitcoin was at 200. And now Bitcoin today is at 20,000. But, oh God, on Real Vision, we got such pushback. You know, this is ridiculous. How dare you? But the macro guys, no, they kind of got
And
it.
how do the macro guys feel about?
Were employees okay with it?
Employees, well, it was split. You know, there's a bunch of people who just didn't like it. And over time, you know, I've been, as you know, very strong on this. And over time, people have left Real Vision because they didn't share that vision. But, you know, I think it proved pretty well that macro and crypto are all different facets of the same thing. They're all, one is the future of money and the future of the financial system and maybe the future of all business models. And the other one is the decaying system. And that kind of pessimism, optimism actually works really well. It gives you lots of opportunity sets. Bitcoin, the largest driver of Bitcoin in the cycle. So if you think about that technology, that gives it this exponential uptrend. So if you put a logarithmic chart, it's actually pretty smooth. What are the cycles driven by? It's driven by liquidity. The biggest driver of Bitcoin is global liquidity, not just the Fed liquidity. So if you use the global bank balance sheets year on year, what you find is that's the thing. So China's already starting to print. The UK is starting to change. I think Europe will be pretty soon. So I think that all we need is a turn. The rate of change needs to turn and crypto turns, which is why, you know, ETH bottomed in June. It's been looking forwards, saying the cycle's turning, and I think it's right. So I think the cycle's turning, and it takes a while to play out. So people would call this crypto spring. You know, spring is a time where, you know, it rains a lot, it's cloudy a bit, sunny a bit, it's cold, it's warm, and that's exactly what the crypto market's like right now. It's just messy, but it's not really going down either. So it doesn't get colder every day. That's winter. So I think we're in crypto spring, and as liquidity changes, and I think that happens relatively soon because things are getting pretty ugly out there. The adoption of technology is relentless. It does not stop. It's not driven by the capital markets. The capital markets mean more entrepreneurs take a shot. Nobody gives a shit if the hurdle rate's 6%. Look at the hurdle rate in India. Look where Indian interest rates are. Where are they today? 7.5%. So 7.5% rates, and how many entrepreneurs have you got? The entrepreneurs in India are going exponential. So it's a nonsense narrative that raising interest rates means that nobody does technology. Go back to the 70s, there was plenty of technology companies like Xerox that took over that period of time. So I don't believe that. I think the adoption of technology is exponential. Again, if people want to understand what I'm talking about, look at India. look at what happened after Aadhaar, India Stack, UPI, and then the Cambrian explosion that happened there. It's astonishing. Crypto right now is the fastest adoption of any technology the world has ever seen. It's twice the adoption speed of the internet.
Sorry, do you mean by number of holders?
Increase in number of holders per year is faster than users of the internet in terms of growth from the first 5 million users. That's where I took it from. So crypto's still growing. This year will be a much flatter year, but it was growing at an average at about 160% a year, and the internet was growing about 80% a year. Twice the speed. So we have never seen a technological adoption as fast as this. And so does interest rates stop that? No. Change in interest rates is the thing that stops it. That liquidity, remember, it's year-on-year rate of change. If they just stopped interest rates, if the US stopped interest rates here, over a while the rate of change goes flat. Assets can do fine in that, because remember, it's technology adoption that actually drives the price over the longer run. So it's the rate of change that's causing it. If the rate of change goes to zero and it flattens out, i.e. interest rates stay sticky, then the chances are that we just get the trend rate of adoption of the technology over time, which still gives it 100% a year rise.
Got it. So even if we were to end up in like higher interest rate environments and maybe you get some inflation, it's still sort of an interesting asset class to be in. I kind of agree with that. I think.
Yeah, what you don't want is interest rates to go from 3.5% to 10%, because that will not be a good investment then. It'll be a very bad investment. But if they stay at 3.5%, 4% for a long period of time, it's fine. What you're hedging here is not inflation, i.e. prices rising, which is usually demand or supply driven. What you're hedging is the debasement of currency, where your purchasing power goes down. So, okay, let's go back one step. What is Bitcoin? Bitcoin is a scarce digital asset, and we either choose to accept it or not, right? Like everything, like gold it's just a metal, but the meme says we should accept it as something of value. So Bitcoin is a meme that is the digital store of value. But it is also a technology. So if we think of Ethereum now and the rest of the crypto space, this is a new tech of which we can use blockchain for a whole bunch of different things. So what we've got is this scarce asset and technology. Okay, great. That's worth something. The other side of the equation is, as you mentioned before, these however many aging white dudes in the United States set the monetary policy for the world, essentially. That liquidity washes in and out of markets. So when it washes out of markets, as it is right now, they're raising interest rates and they're reducing the balance sheet. That's taking money out of the system. So it's a game of musical chairs. So what happens is people are scrambling for dollars, and you see currencies falling around the world, but also people can afford less assets because there's less leverage, less money around. So the price of Bitcoin, NASDAQ, everything falls. I mean, literally everything, house prices. And the dollar goes up because there's less dollars around.
That's what's happening right now.
That's happening right now. So if we go back to 2020, what happened was massive liquidity coming in, plus debasement of currencies, quantitative easing. Right now, we've got the opposite of debasing of currencies. We've got quantitative tightening. So the currency is actually getting stronger, so the assets should go down versus that. But back then, we had like a 50% increase in the Fed balance sheet. We've never seen that much monetary expansion in the modern history of the United States. And so what happens is, you then look at all of the assets, and what did best out of that was Bitcoin, or all of crypto. Why? Because not only, so gold did okay and equities did well, but Bitcoin did really well because you had both the technology bet and the monetary bet. And so it outperformed. So if we're in an age when the central banks are straddled, the global economies are straddled with debt, and this doesn't apply to India as much as it applies to the Western developed nations, is their only answer is to print money to avoid catastrophe, because who pays the debt? So the central banks backstop it. So over time, they're going to keep doing this trick because it's a magic trick, because it makes asset prices go up and everyone looks like they're rich. but you're not rich because you actually can't afford a house because it keeps going up in value because your wages don't go up. And the asset you need to own for all of that is crypto, because it's the thing that outperforms and gives you more purchasing power.